Welcome back to the deep dive. We are in the business of taking the densest regulatory frameworks, the kind of documents most people would just file away unread, and distilling them down into clear, actionable knowledge.
And today we're tackling a big one. We're doing a section-by-section masterclass on the Limited Liability Partnership Act of 2008.
This deep dive is, I think, essential because the LLP is arguably the most strategic modern vehicle for professional collaboration and entrepreneurial growth.
It really is. We aren't just reading a statute today. We are unpacking a finely tuned legal machine, one that's designed to balance corporate-level protection with partnership-level flexibility.
Our mission for you, the listener, is pretty comprehensive. By the time we are through, you will understand the structure, the required compliance, and the core mechanics of the LLP.
You'll have a command of the logic behind every major provision. The goal is that you can effectively use this knowledge without having to pore over hundreds of pages of legal text.
Okay, let's unpack this then. We had two established models, the unlimited partnership and the highly regulated company. What exactly was the legislative imperative that drove India to create this hybrid third way?
Well, the creation of the LLP was a direct response to a real gap in the existing commercial structure that was, frankly, holding back professional enterprises.
A gap they wanted to fill quickly, it seems.
Oh, yes. If you look at the legislative history, the Ministry of Law and Justice saw this need early on, notifying the draft LLP Act in January 2007. It gained parliamentary approval in December 2008 and got the president's assent in January 2009. It was operational almost immediately.
Yeah, it's a pretty swift movement. It suggests a high degree of urgency.
It was absolutely necessary. I mean, the traditional partnership structure, the one from the 1932 Act, it deterred so many professionals, lawyers, accountants, consultants from collaborating on a large scale.
Because of the liability.
Right. Because of the terrifying reality of unlimited personal liability. A single act of malpractice by one partner could potentially bankrupt all the others. We're talking about exposing their homes, their personal savings.
And a full-blown company was just too much overhead.
For many, yes. The strict statutory governance of a limited liability company was often too rigid, too bureaucratic for small or specialized professional teams.
So the LLP was born to offer a safe middle ground, a structure where liability is limited, but the operational agreement remains contractually flexible.
That's it, exactly. The LLP was explicitly designed to encourage professional expertise and entrepreneurial initiative by giving them protection from that unlimited personal risk while still letting them run their internal affairs like a traditional partnership.
Can you give us a quick overview of the legislative framework itself?
Structurally, the Act is quite tight. It has 81 sections, though Section 81 was omitted back in April 2022. And it also includes 4 crucial schedules.
Schedules, what do they cover?
The first schedule, for instance, is basically the default rulebook. It steps in to govern the rights and duties of partners if their own LLP agreement is silent on something.
A safety net.
A legal safety net. And Schedules 2, 3, and 4, they detail the specific mechanics for converting existing entities, so traditional firms, private companies, and unlisted public companies, into this new LLP structure.
And who's in charge of supervising all these LLPs?
The administrative responsibility lies with the Ministry of Corporate Affairs, the MCA, and it's administered primarily through the Registrar of Companies, or ROC.
Okay, and this is a foundational point we need to hammer home.
This is the most important legal principle to remember. The Indian Partnership Act of 1932 is not applicable to LLPs.
Not at all.
No. The LLP Act 2008 is a completely self-contained, standalone piece of legislation.
Let's lock down that core identity then. When we call the LLP a hybrid, what specific legal components are we talking about?
Legally, the LLP is a distinct new form of entity. It's an alternative corporate business vehicle. The hybrid DNA, as you call it, comes from blending the strongest protective feature of a company, that's the limited liability, with the best operational feature of a partnership.
Which is the internal flexibility.
The internal contractual flexibility, all based on mutual agreement. It's really the ultimate combination of protection and practicality.
I want to break down that protection mechanism a bit more. How does the liability structure work in practice?
It operates on what you could call a dual shield. First, the LLP itself is a separate legal entity.
So it can own property, sign contracts.
In its own name, yes. And critically, it is liable to the full extent of its own assets. Second, and this is the protection for the individual partners, their liability is strictly limited to their agreed-upon capital contribution.
So if the LLP gets into financial trouble, creditors go after the LLP's assets, not the partner's houses.
Exactly. They pursue the entity's assets, not the partner's personal wealth.
That separation is huge. It removes the fundamental risk that came with a traditional firm.
It does, and that leads to the key analytic insight here. This framework makes the LLP uniquely suitable for professionals. Think about high-risk, high-reward service providers, engineering firms, boutique law chambers, massive auditing consortiums.
All places where one mistake could be catastrophic.
Right. The previous unlimited liability was a major deterrent. The LLP removes that barrier, encouraging investment and large-scale ventures in the service sector. It's also highly attractive for venture capital because its governance is so much simpler than a full company structure.
Okay, to really understand the mechanics, we need to nail down the specific language the Act uses. Let's start with something basic, how the Act defines an address.
Sure. We look at the definition of address in Section 2.1. The Act is very clear. If the partner is an individual, the address is their usual residential address. If the partner is a body corporate, it's the address of its registered office. Simple, but legally necessary.
Now, one of the more complex definitions, I think, is body corporate, because it really sets the boundaries of who can even be a partner in an LLP.
It is comprehensive and absolutely crucial. A body corporate explicitly includes a company under the Companies Act, an LLP registered under this act, foreign LLPs, and foreign companies.
So it's pretty open to corporate participation, both domestic and international.
Yeah, very. But the list of exclusions is just as important. It specifically excludes a corporation's sole, like a religious office holder, and cooperative societies.
Why co-ops?
They're generally for mutual benefit, not corporate profit. The Act also lets the central government exclude any other body it specifies. This keeps the LLP squarely within the corporate profit-seeking regulatory sphere.
And what about the scope of the business itself? Are there any limits?
The scope is deliberately expansive. It includes every trade, profession, service, and occupation. The goal is maximum commercial facilitation. The only real safeguard is that the central government can, if needed, exclude certain activities by official notification. Otherwise, if it's lawful and profit-driven, it counts.
We've noticed the Act often points to definitions in other professional laws.
And that's a sign of a well-integrated legal framework. For instance, a chartered accountant is defined strictly by the Chartered Accountants Act of 1949. It requires not just membership, but also a valid certificate of practice. This makes sure the partners meet their own professional body's highest standards.
We'll get into the weeds on designated partners shortly, but what's the basic definition of a designated partner or DP?
Very simply, it is any partner who has been formally designated to carry out the legal compliance functions according to the requirements in Section 7. They are, in effect, the compliance officers of the LLP.
Okay, let's pause on the term entity. I find this one unusual because it seems to change its meaning depending on which section of the Act you're reading. What's the logic there?
That's a remarkable piece of legislative detail, and it points to a need for regulatory flexibility. Generally, entity just means anybody corporate. But for specific purposes like investigations, inspections, or imposing penalties, the definition is deliberately broadened.
Broadened to include what?
To include a traditional firm set up under the Indian Partnership Act of 1932. The legislature wanted to make sure that when the regulatory machinery needs to look into something, its reach isn't limited just to body corporates. It's a mechanism to prevent firms from using different legal wrappers to dodge scrutiny.
Very clever. Now, for financial planning, the financial year definition is crucial. It's April 1st to March 31st. But there's a very practical exception for new LLPs.
It is designed to be highly pragmatic, aligning perfectly with the income tax cycle. The flexibility kicks in if an LLP is incorporated after September 30th of a given year.
So let's walk through an example. Say an LLP is incorporated on October 15th, 2022.
Right. If they were forced to close their books on March 31st, 2023, they'd only have 5.5 months of data. That's an administrative nightmare to audit and file. So the Act allows them to extend their first financial year until March 31st of the next year.
So until March 31st, 2024 in this case.
Exactly. It gives them a full run-up period. The key constraint, though, is that this extended first year can never exceed 18 months in total. That ceiling ensures compliance reporting doesn't get pushed back too far.
That makes a lot of sense. What about the international definition?
A foreign LLP is an LLP that's incorporated outside India but decides to establish a place of business within India. The moment they do that, It triggers all the necessary compliance and regulatory oversight under the Indian Act for their domestic operations.
And the core document that governs all the internal behavior is the LLP agreement.
That document is the source of all the structural flexibility. It's the written contract. It determines all the mutual rights and duties among partners and between the partners and the LLP itself. It is paramount.
But what if it's silent on a particular issue?
That's where the failsafe comes in. If the agreement is silent, the default rules laid out in the first schedule immediately apply. This mechanism ensures there are no legal vacuums in governance.
And finally, we have to mention the new category introduced by the 2021 amendment, the small limited liability partnership.
This is a major insight into current government thinking, reducing the compliance burden for genuinely small entities.
And that's based on numbers, right?
Two quantitative thresholds. First, the total contribution must not exceed 25 lakh rupees, though the government has the power to raise that cap up to 5 crore. Second, the turnover in the preceding financial year must not exceed 40 lakh rupees, again, with a possible cap up to 50 crore.
So LLPs that fit into that small box might get some regulatory relief?
Exactly. They may be granted exemptions or have reduced statutory burdens, making the structure even more appealing to microenterprises.
It makes compliance proportional to size, which feels very equitable. And before we move on, the Act itself says that any terms it doesn't define default to the definitions in the Companies Act 2013.
That structural reliance ensures that the interpretation of corporate language stays consistent. And we must state it one more time. Section 4 makes the Indian Partnership Act of 1932 completely non-applicable. LLPs are a different species.
Okay, we've established the guardrails with the definitions. Now let's see how those pieces fit together to create the essential characteristics that make the LLP structure so compelling.
We begin with the most crucial characteristic. The LLP is a body corporate. It is formed by registration under the Act, which grants it an identity entirely separate from the individuals who created it.
And that separate identity grants it perpetual succession. This is the corporate guarantee of immortality, right?
It is. The LLP's existence is independent of its membership. The death, retirement, insolvency, or even the insanity of a partner has no legal impact on the LLP's operations, its rights, or its liabilities. It just continues indefinitely until it's formally dissolved by legal process.
This inherent stability provides the necessary confidence for long-term projects and investment. And because it's a separate legal entity, the liability rules are crystal clear.
That's the essence of it. The LLP is liable for its own debts, not the partners personally. The LLP's liabilities are met solely out of the LLP's property.
I want to focus on that concept of an artificial legal person. It's a creation of law, but what are the limits on what it can do?
Well, it holds rights like an individual for commercial functions. It can sue, it can own property, it can sign contracts, but because it doesn't have a physical body, it can't engage in natural human actions.
It can't be put in jail.
It can't serve jail time,
Mm-hmm.
it can't get married, and it can't practice professional services like medicine or accountancy directly. Those things have to be performed by authorized human partners. It's an important distinction.
One feature often associated with corporate identity is the seal. Is a common seal mandatory for an LLP?
No, and this is a subtle nod to the partnership's flexibility. Unlike many traditional companies, the common seal is completely optional for an LLP.
And if they do choose to have one?
Then the Act is clear on the procedural safeguard. It must be kept safe and can only be affixed to official documents in the presence of at least 2 designated partners, which ensures accountability.
Let's move to the operational structure, specifically the difference in agency, which is really the cornerstone of the LLP structure. Mutual agency.
In traditional partnerships, a partner is an agent of the firm and an agent of every other partner. In an LLP, that relationship is fundamentally inverted.
How so?
Every partner is an agent of the LLP alone. They're explicitly not an agent of the other partners. This is the liability shield in action. If partner A makes a catastrophic business error without authority, partner B is generally protected from joint liability.
This single rule makes the LLP exponentially safer for collaboration than a traditional firm.
Absolutely. And the internal operational freedom comes from the LLP agreement, where the partners set their own mutual rights and duties. They can tailor profit sharing, management roles, anything they need. And if they miss something, the first schedule is that default safety net.
Reaffirming the core principle. Limited liability is restricted to the agreed contribution, unless fraud is involved.
Correct. The liability is capped. Let's think about that example of, say, 50 software consultants forming an LLP. Before 2008, If one consultant was sued for a massive technical failure that led to a $100 million loss, all 50 partners could lose their personal assets.
Everything.
The LLP structure restricts that liability exposure to the entity's assets and the partner's pre-agreed capital contribution. It just encourages the formation of these large professional service corporations.
So who governs the internal operations and who manages the external compliance?
The management of business is generally handled by the partners as they see fit in their agreement. However, the external legal duties, the statutory compliance, filing financial statements, dealing with the ROC, those are the mandated duties of the designated partners alone. They are the compliance gatekeepers.
And LLPs can't be vehicles for social good or charity.
That's right. A fundamental requirement is that the LLP must be established for carrying on a lawful business with a view to earning profit. It is explicitly a commercial entity.
What about size constraints? We know there's a minimum, but is there a hard ceiling on the number of partners?
The requirement is a minimum of 2 partners. But the beauty of the LLP model is that there is no maximum limit. This allows for massive scaling, which you often see in large law firms or accounting networks.
And what tools does the central government have for oversight?
The government retains extensive powers for investigation into the LLP's affairs. The Act also provides a clear framework for compromise or arrangement, things like restructuring and mergers. And of course, the schedules make it easy for existing firms and companies to convert into an LLP.
We mentioned digital governance earlier. The requirement for e-filing of documents is not just an option, it's mandatory.
It is the standard operating procedure. All required documents must be filed in electronic form on the MCA website and authenticated by a digital signature. This ensures the public record is maintained efficiently and is digitally accessible.
And finally, just confirming the role of international players.
Foreign LLPs can set up shop here, and they can also be partners in Indian LLPs. However, any non-resident investment requires strict adherence to foreign direct investment or FDI policies. That ensures foreign capital is regulated appropriately.
All right, let's delve deeper into the people running the LLP, starting with the eligibility rules under Section 5.
Eligibility is quite simple. Any individual or any body corporate. However, the ineligibility criteria for individuals are absolute and non-negotiable.
Such as?
You cannot be a partner if you are an undischarged insolvent, if you have a pending application to be adjudicated as insolvent, or if a court has found you to be of unsound mind and that finding is still in force. These are measures to protect the financial stability and credibility of the LLP.
So who can participate?
The roster is pretty diverse. Resident Indians, non-resident Indians, overseas citizens of India, foreign nationals, and any registered body, corporate, domestic, or foreign. The only constraint for foreign involvement, as we said, is complying with those FDI rules.
Now, we have to address the severe penalty for breaching the minimum partners requirement. Why is this structural rule so heavily enforced?
The rule demands at least 2 partners. The heavy enforcement is necessary because limited liability is a privilege granted by statute, and that privilege is based on the existence of a partnership structure. If that structure fails, the privilege is threatened.
And the core threat is what exactly?
If the number of partners drops below 2, and the remaining single partner carries on the business for more than 6 months while being aware of the breach, that single partner becomes personally liable for all LLP obligations incurred during that period.
So the limited liability shield just vanishes.
It immediately lifts. This ensures partners act swiftly to appoint a replacement. It's a powerful deterrent against negligence in governance.
The burden of compliance falls squarely on the designated partner. What are the key statutory demands for DPs under Section 7?
Every LLP must maintain at least 2 designated partners, who have to be individuals, not companies. And crucially, at least one of those DPs must be a resident in India.
And the definition of resident in India has a precise numerical threshold.
It does. For the purposes of this act, a resident is someone who has stayed in India for a period of not less than 120 days during the financial year.
That's shorter than the usual 182-day rule for company directors?
It is, which signals the LLP Act's slightly more relaxed approach to global participation while still ensuring there's essential local accountability.
Let's test this. An LLP has 5 partners, 2 non-residents, 3 residents. They appoint the 2 non-residents as DPs. Why is this non-compliant?
It fails because neither of the DPs satisfies the 120-day rule. To comply, they have to ensure one of the two DPs is one of the three resident partners. This makes sure that in any regulatory crisis, there is a designated person physically available in the country who is legally responsible.
What happens when the LLP itself is composed entirely of companies and there are no individual partners?
This is covered by a proviso to Section 7(1). In that case, the LLP must appoint at least two individuals who are either partners or, more likely, nominees of the corporate partners to act as DPs.
So if an LLP has three corporate partners,
They can't appoint the companies themselves as DPs. They have to appoint nominees, real people from those companies. For instance, the CEO of one and the CFO of another could be appointed. They serve as the human agents responsible for the corporate compliance of the LLP.
and once selected, what's the formal process for a partner becoming a DP?
Well, the individual has to provide their prior written consent to act as a DP. The LLP then has a strict obligation to file the particulars of the appointment, along with that consent, with the registrar within 30 days.
And they need a DPIN.
Yes, every DP must obtain a designated partner identification number, or DPIN, from the central government. It mirrors the Director Identification Number from the Companies Act, ensuring unique identification and tracking.
Let's discuss the weight of that DP role. What are their statutory liabilities under Section 8?
The liability is profound. DPs are responsible for performing all acts, matters, and things required for compliance under the Act. This includes signing and filing all documents, returns, and statements.
And this is the critical part.
They are personally liable for all penalties imposed on the LLP for any resulting contravention. The limited liability shield that protects a standard partner from commercial debt does not protect the DP from compliance penalties.
That distinction makes the DP role much riskier than being a standard partner. What are the rules for managing changes in DPs?
The LLP has to act quickly. If a DP vacates the office, the LLP must appoint a new DP within 30 days. That's the formal deadline.
And if they fail to do that?
Then the regulatory failsafe activates. If no DP is appointed, or if the LLP temporarily runs with only one DP, then every partner is automatically deemed to be a designated partner until the vacancy is filled.
So the compliance burden and the personal penalty liability immediately spreads to everyone.
Exactly. It ensures the LLP corrects the structure urgently.
And the Act backs these duties up with clear financial threats.
The penalties are specific under Section 10. For the major structural failure, failing to maintain two DPs or the resident DP, the LLP faces a penalty starting at 10,000 rupees and maxing out at 1,000. And every single partner also faces a maximum penalty of 50,000.
And for the procedural failure of not filing the consent on time.
For that, the penalty is slightly lower. 5,000 rupees, maxing at 50,000 for the LLP, and a maximum penalty of 25,000 for every DP. Those the financial mandates highlight that the integrity of the DP structure is absolutely non-negotiable.
So once the partners and DPs are identified and they've agreed on the structure, we move to the formal process of creation.
The legal genesis starts with the incorporation document under Section 11. This document must be subscribed to by at least two persons who intend to carry on a lawful business for profit. This sets the commercial intent.
It gets filed with the registrar. What assurances are required at that filing stage?
The document must be accompanied by a statement of compliance. This is a powerful legal safeguard. The statement confirms that all requirements of the Act have been met.
And who signs that?
It has to be signed by a qualified professional, an advocate, company secretary, chartered accountant, or cost accountant, who is actively involved in the LLP's formation, along with one of the initial subscribers. This places professional liability on the certifying third party, reinforcing the integrity of the process.
What are the mandatory pieces of information required in the document itself?
It has to include the proposed name of the LLP, the proposed business activity, the official address of the registered office, the names and addresses of all initial partners, and critically, the names and addresses of the initial designated partners.
And the penalty for providing false information here is extremely serious.
It is the first instance of severe penal action. The penalty for making a false declaration, if you do it knowingly, exposes you to imprisonment for up to 2 years and a fine between 10,000 and 5 lakh rupees.
Wow, so actual jail time for lying on a form.
The legislature recognizes that the entire legal status rests on the veracity of these documents, so misrepresentation is punished as a crime.
So, if the filing is compliant, The registrar proceeds with incorporation by registration.
Yes, under Section 12, the registrar issues a certificate within 14 days.
And that certificate is the ultimate proof of legal existence.
It is conclusive evidence that the LLP has been duly incorporated under the Act. From that moment, the LLP exists as a legal person.
Let's discuss the registered office. This isn't just a mailing address, it's the official legal hub.
It's the mandatory address for all formal communications and notices. And if the LLP wants to change this crucial address, the change only takes legal effect once they file the necessary notice with the registrar.
And if they don't?
If they fail to comply with any part of Section 13, the LLP and every partner face a penalty of 500 rupees per day, up to a maximum of 50,000.
So once registered, what are the corporate powers the LLP acquires?
The effect of registration is that the LLP is fully clothed with commercial legal capacity. It can sue and be sued in its own name. It can acquire, own, and dispose of property. It can adopt a common seal. And generally, it can do anything a body corporate lawfully can.
How does the LLP ensure its name is unique and legally compliant?
The name requirements in Section 15 demand two things. First, the name must end with the required suffix, either limited liability partnership or LLP. Second, the name can't be deemed undesirable by the central government, and most importantly, it can't be identical or too closely resemble the name of an existing company, another LLP, or a registered trademark.
And if an entrepreneur wants to lock a name down before full incorporation, they use reservation of name.
Yes, through an e-form. If the name is approved by the registrar, it's reserved for 3 months. This gives the founders time to finalize their documentation without losing their desired name.
What if, after incorporation, it's discovered that the name is too similar to an existing entity? This is rectification of name.
If the resemblance is discovered, the central government can direct the LLP to change its name within 3 months upon receiving an application from the aggrieved party.
Is there a time limit for a trademark holder to object to a new LLP's name?
Yes, the Act provides a specific window. The proprietor of a registered trademark has to file their application for rectification within 3 years from the date the LLP was incorporated. After 3 years, that right is generally lost.
And if the LLP is directed to change its name, what are the compliance steps?
They have to notify the registrar of the name change within 15 days, and crucially, the LLP agreement itself must be formally changed and filed within 30 days.
Let's analyze this scenario. If Ms. Vardman Steele's LLP has a name similar to Ms. Vardaman Steele's, which is a traditional partnership firm, does the LLP have to change its name?
This is a perfect example of why the definitions matter. The power to force a name change under Section 17 is limited to resemblance with existing LLPs, companies, or registered trademarks. Since Ms. Vardaman Steele's is just a traditional firm, it doesn't hold that statutory protection.
So the LLP is safe.
Ms. Vardaman Steele's LLP is not legally obliged to change its name under this provision. It really underscores the different legal standing of the two types of entities.
Let's summarize the flow of creation one last time.
First, name reservation. Second, filing the incorporation document using the e-form fill-up. Third, and this is mandatory, executing the LLP agreement, the internal constitution, and filing it within 30 days of receiving the certificate of incorporation.
Now, for the absolute core of the Act, how the liability shield functions and, more importantly, how it can be pierced.
Once more, the guiding principle. Every partner is an agent of the LLP, but not of the other partners. The partner's authority is channeled exclusively through the entity.
And when does that channel break down? When is the LLP not bound by a partner's unauthorized actions?
The LLP is protected if the partner acted without the authority of the LLP and the third party either knew the partner lacked authority or didn't believe the person was a partner. It's a protection against rogue agents.
Conversely, the LLP is liable for wrongful acts, provided those acts were done in the course of the business or with the LLP's explicit authority.
Yes, the LLP structure doesn't shield the business from its own professional negligence. And the consequence of this is clear. Any obligation is solely the LLP's obligation, and liabilities must be met strictly out of the property of the LLP.
Let's nail down the partner's personal protection.
No personal liability for LLP obligations. Just by being a partner, you are not personally responsible for the LLP's contracts or debts. You are shielded, provided you've paid your agreed capital contribution.
However, the Act doesn't allow partners to hide behind the LLP for their own mistakes.
Correct. They retain personal liability for their own wrongdoing. If a partner commits a wrongful act, they are personally liable for it. But, crucially, they are protected from personal liability for the wrongful acts committed by other partners.
Let's look at this in practice.
Yeah.
Devi Ram Food Circle LLP owes Mr. Mudit 10,000 rupees, but only has 7,000 tasens. Can the partners be forced to cover the 3,000 shortfall from their personal savings?
Unless fraud is involved, absolutely not. The LLP is the debtor, not the partners. Mr. Mudit is a creditor of the separate legal entity. The partner's liability is limited to their agreed capital contribution. They are protected by the limited liability structure from the commercial debts of the business. This is the central promise of the LLP Act.
The limited liability shield is strong, but there are two main ways it can be breached. The first is holding out.
Holding out is all about misrepresentation. If a person, through their words or conduct, represents themselves as a partner, and a third party relies on that to extend credit to the LLP, that person is personally liable to the third party.
It doesn't matter if they were a real partner or not.
No. Their action led to the loss, so they are personally liable. The LLP is also liable, but only to the extent it got a financial benefit from that credit, is a key honesty principle.
And there's an interesting post-death protection here.
Yes.
Yeah.
If the LLP continues using a deceased partner's name, that act alone does not make the deceased partner's estate liable for the LLP's subsequent acts.
The second and most devastating exception is unlimited liability in case of fraud. This is the ultimate regulatory deterrent.
It is the complete removal of the limited liability privilege. If the business is carried out by the LLP or its partners with the intent to defraud creditors or for any fraudulent purpose, the liability of the LLP and any partner or employee involved becomes unlimited.
So this is where the shield just evaporates completely.
It does. It exposes the personal assets of the perpetrators to the full extent of the firm's debts.
And this carries severe criminal penalties, not just financial ones.
Precisely. The penalties for fraud include imprisonment that can go up to 5 years, plus a substantial fine ranging from 50,000 up to 5 lakh rupees. And on top of that, the fraudulent parties are liable to pay compensation to anyone who suffered a loss. It shows that limited liability is entirely conditional on operating with integrity.
To aid in uncovering that kind of fraud, the Act provides protection for insiders who come forward.
The whistleblowing provisions allow the court or tribunal to waive or reduce penalties for a partner or employee who provides information that leads to a conviction. Crucially, the Act also provides statutory protection against retaliation. They can't be fired, demoted, or harassed for disclosing that information. It's a powerful tool for self-policing.
Finally, let's just clarify what constitutes a capital contribution.
The form of contribution is very broadly defined. It can be money, tangible assets, intangible property like IP or goodwill, promissory notes, or even contracts for services. The only requirement is that the monetary value of that contribution must be properly accounted for and disclosed.
What if partners agree internally to reduce a contribution obligation?
The obligation to contribute is clear. If a creditor relied on the publicly stated contribution amount when extending credit, and the partners later internally compromised that obligation without public notice, the creditor still has the right to enforce the original higher obligation against that partner.
So you can't secretly shield assets that creditors expect to be there. When a partner leaves, the process must be carefully managed to maintain the public record and protect both the LLP and the departing partner.
A partner can leave through two mechanisms. The primary method is according to the specific terms set out in their LLP agreement. If the agreement is silent, they have to give the other partners at least 30 days written notice of their intention to resign.
And what are the events that automatically trigger a partner's exit?
There are 4. The death of the partner, the dissolution of the LLP, being declared of unsound mind by a court, or being declared insolvent.
Here is the key danger zone: the liability of a former partner. When does a departed partner officially stop being liable to the outside world?
They are deemed to be a partner to outsiders unless the third party dealing with the LLP has notice of the cessation or a notice has been officially filed with the registrar. Cessation doesn't automatically discharge any existing obligations, but it has to be made public to avoid future liability.
So let's use that example again. Abhinav resigns from his LLP, but no one files the notice with the ROC. Is Abhinav liable for a massive debt the LLP incurs 6 months after he left?
Yes, he is, and this is the crux of the failure. Since neither Abhinav nor the LLP filed the required notice, Abhinav is still listed on the public record as a partner. Any creditor would reasonably assume he was still a partner.
So just because he didn't file a form, he's on the hook for a debt incurred after he left. That's harsh.
It is, but it underscores the absolute importance of the public record. Because he failed to provide public notice, he remains personally exposed and liable.
What are the financial rights of the departing partner?
Upon cessation, the former partner is entitled to receive their actual capital contribution and their calculated share in the accumulated profits, minus any losses calculated as of the date they left, and they immediately lose all rights to participate in management.
So the Act places a dual duty on filing these changes.
Yes. First, the partner's duty. Any partner must inform the LLP of any name or address change within 15 days. Second, the LLP's duty is to file a notice with the registrar within 30 days of a person joining, leaving, or changing their name.
And if they fail, there are penalties.
A 10,000 rupee penalty for the LLP and every DP.
What if the LLP is uncooperative and fails to file a departing partner's resignation notice? Can the partner protect themselves?
This is a really important safeguard for the former partner. They have the right to file the notice themselves. If a former partner believes the LLP won't file the notice, they can do it. And if the LLP doesn't officially confirm or deny it to the registrar within 15 days, the registrar must register the notice. It's the ultimate tool for a departing partner to legally sever their public connection.
This is where the LLP looks most like a corporation, adhering to strict financial transparency standards.
That's right.
So what level of accounting rigor is required?
High rigor. Section 34 mandates the maintenance of proper books of account. These must be maintained on a cash or accrual basis, and crucially, using the double entry system of accounting. This is a specific corporate requirement and a major distinction from simple partnership accounting.
And the annual financial transparency document is the Statement of Account and Solvency, or SOANS.
It has to be prepared within 6 months of the close of the financial year, covering the previous FY and signed by the designated partners. This statement confirms the financial health and solvency of the LLP. It must then be filed annually with the registrar.
Is the annual audit always mandatory?
Generally, yes, the accounts must be audited. However, the central government has the power to exempt certain classes of LLPs via notification. This power is often used to relieve the compliance burden on very small LLPs, though the fundamental requirement for accurate books always remains.
And the penalties here reflect the state's interest in public financial transparency. What's the fine for simply filing the SOANS late?
For failing to file on time, the LLP is penalized 100 rupees per day, up to a maximum of 1,000. DPs face a maximum of 50,000.
But the fine for failing to maintain the underlying records is much higher. Why the distinction?
The fine for general non-compliance, so failing to maintain proper books, prepare the SOANS, or get the mandatory audit, is significantly steeper. We're talking up to 5 lakhs for the LLP and up to 1 lakh for DPs.
What's the logic there?
The logic is clear. The government views a failure to maintain accurate, double-entry books as a fundamental breakdown of integrity. It's far more serious than merely filing those records late. Transparency relies on accurate underlying data.
Beyond the financial statements, the LLP also has to file a general annual return.
Yes, within 60 days of the close of the financial year. So if the financial year ends on March 31st, the annual return is due by May 30th. This is a mandatory corporate compliance element, and failure to file incurs that 100 rupee per day penalty.
And what standards guide the preparation and audit of these financials?
Section 34A ensures conformity. The central government, in consultation with the National Financial Reporting Authority, or NFRA, will prescribe the necessary accounting and auditing standards. This ensures high, uniform quality across all regulated entities.
How does the public verify an LLP's compliance?
Through inspection of documents. Key documents, the incorporation document, partner changes, the SOANS, and the annual return, are all publicly available upon payment of a prescribed fee. This transparency is key to building creditor confidence.
And what if the registrar needs internal information?
The power of the registrar to obtain information is robust. The registrar can summon and demand information in writing from present or former partners, DPs, or even employees. Failure to comply with a summons is punishable by a fine up to 25,000 rupees.
And the most serious deterrent regarding information integrity?
The penalty for false statements. Making a false statement or omitting material facts in any filing is severe, imprisonment up to 2 years, and a fine between 1 lakh and 5 lakhs. The act is unequivocal. The public record must be truthful.
Let's discuss the administrative way out for minor regulatory lapses compounding.
Compounding of offenses allows offenses to be settled administratively rather than through court, avoiding criminal prosecution. This power is delegated to the regional director. Crucially, it applies only to offenses punishable with a fine only. If imprisonment is a possibility, compounding is off the table.
What limits the government's discretion on the compounding amount?
The compounding amount can be up to the maximum fine prescribed for the offense, but it cannot be lower than the minimum fine.
And what prevents chronic non-compliance through repeat compounding?
The Act imposes a strict cooling-off period. An offense cannot be compounded if a similar offense was compounded within the preceding 3 years. This is a powerful check against habitual offenders.
If a partner wants to step away from the financial upside but retain their management role, is that possible?
The opposite is true. A partner can transfer their financial interests, their right to a share of profits, losses, and distributions, wholly or in part.
And how does that transfer affect the structure?
The transfer of financial rights does not cause the disassociation of the partner or the dissolution of the LLP. The original partner remains legally responsible. Furthermore, the recipient of that financial interest is strictly not entitled to participate in management or access information.
So I can sell my share of the profits, but I can't sell my seat at the management table.
Exactly. They are purely passive financial stakeholders. This clearly separates financial investment from management authority.
For existing organizations, the conversion process is a major draw to the LLP model. Which entities are eligible?
3 types are specified in the schedules: a traditional firm, a private company, and an unlisted public company.
And what is the legal effect of receiving the certificate of registration after conversion?
It is a profound change. All tangible and intangible assets, rights, privileges, and liabilities of the old entity are automatically and entirely transferred to and vested in the new LLP.
So the old company or firm just ceases to exist.
It is deemed to be dissolved and removed from the original registrar's records. It seamlessly continues operations under the new protective legal wrapper, and the final administrative step is that the new LLP must inform the respective registrar of the conversion within 15 days.
Restructuring often involves creditors. How does the LLP Act manage compromises?
A compromise and arrangement can be proposed between the LLP and its creditors, or the LLP and its partners. The tribunal, the NCLT, orders a meeting. The key threshold for approval is substantial. A 3/4 majority in value of the affected creditors or partners must agree.
A 3/4 majority. That ensures significant consensus.
It does. And if it's sanctioned by the tribunal, the arrangement is binding on all parties. The order then has to be filed with the registrar within 30 days.
Is there a constraint on who an LLP can merge with?
Absolutely. The explanation to Section 62 contains a critical prohibition. A limited liability partnership shall not be amalgamated with a company.
Wait, so an LLP can't merge with a company. Why is that?
They can only merge with other LLPs. This reflects the deep structural and regulatory differences between the 2 entity types, especially concerning things like shareholder rights and statutory governance.
Can the tribunal dissolve an LLP without going through the full, complex winding-up process?
Yes, under certain conditions during a reconstruction. The tribunal can order the dissolution without winding up of a transfer LLP, provided the official liquidator confirms that the LLP's affairs were managed properly and weren't prejudicial to the partners or the public interest.
And if it does come to a full winding up?
Winding up and dissolution can be initiated voluntarily by the partners or compulsorily by the tribunal.
What are the 5 statutory grounds for compulsory winding up by the tribunal?
These grounds represent fundamental failures of the LLP's mandate. 1, the LLP itself resolves to be wound up. 2, the number of partners has dropped below 2 for more than 6 months. 3, the LLP acted against the sovereignty or security of India.
Okay, those are serious. What about compliance failures?
That's number 4. The LLP has defaulted in filing the statement of account insolvency or the annual return for 5 consecutive financial years.
5 years. That's an explicit penalty for regulatory indifference.
It is. And the 5th point is a catch-all. The tribunal deems it just and equitable to wind up the LLP. This highlights that the LLP must perform its corporate duty of public transparency. Failure to do so persistently is grounds for judicial termination.
Does a partner's separate legal status allow them to transact with the LLP as if they were an external vendor?
Yes, Section 66 confirms this separation. A partner can lend money to the LLP or engage in business transactions with it, and for the purpose of that transaction, they possess the same rights and obligations as a person who is entirely external to the partnership.
So a loan from a partner is a real debt, not just capital.
Exactly. It's treated as a debt.
And the Act has a future-proofing mechanism.
A crucial one. Section 67 grants the central government the power to apply any provision of the Companies Act, 2013, to LLPs, simply through official notification. This allows the LLP framework to quickly adapt to new corporate governance standards without needing a slow, full legislative amendment.
And for documents filed late, what is the administrative remedy?
Payment of an additional fee. The registrar can accept late filings upon payment of an additional fee, although this accommodation doesn't shield the LLP from any other liability that might arise due to the delay.
And the regulatory response to repeat offenders?
Enhanced punishment. Section 70 mandates that for a second or subsequent offense under the Act, the fine imposed must be twice the amount prescribed for the first offense. It's a clear, statutory escalating mechanism.
To synthesize everything we've covered, let's break down the strategic choice for a business starting today, contrasting the LLP with the two alternatives. Let's start with the traditional partnership firm.
The difference is night and day, and it all rests on liability and structure.
Okay, rapid fire. Legal status.
The LLP is a separate body corporate with perpetual succession. The partnership is just a collection of individuals with no separate legal existence.
Liability.
This is the big one. Limited for an LLP, unlimited for a partnership. It's that simple.
Agency.
In an LLP, a partner binds only the LLP. In a partnership, a partner binds the firm and all other partners. This makes the LLP fundamentally safer.
Compliance.
The LLP requires designated partners, annual filings, and double entry accounting. The partnership has none of these mandatory requirements with the registrar of firms, so strategically, a business chooses the partnership only if maximum simplicity and zero compliance costs are required and the commercial risk is acceptable.
But if growth or external investment is expected?
The LLP is the superior choice, hands down.
Now let's compare the LLP to a limited liability company. Both offer protection. Where does the trade-off lie?
Here the choice is between operational flexibility and statutory rigidity.
So governance.
LLP governance is based on the contractual LLP agreement, which offers massive flexibility. Company governance is strictly dictated by the Companies Act.
Ties and names.
LLPs have no maximum partner limit. A private company is capped at 200 members. Both have mandatory suffixes, LLP versus private limited.
Management.
In an LLP, management is by the partners according to their contract. In a company, management is strictly separated from ownership and run by the board of directors.
So what's the strategic choice here?
A business chooses a company if it intends to raise capital publicly through equity shares or requires a clear separation between ownership and management. They choose the LLP if they value internal flexibility and want to keep administrative governance simple. The LLP is the professional's choice. The company is the investor's choice.
The LLP structure is truly a regulatory masterpiece, isn't it? Designed to maximize entrepreneurial spirit while imposing just enough corporate accountability to keep it credible.
That structural flexibility, coupled with the liability shield, truly explains why the LLP is now such a dominant force in the professional service economy.
We've taken this deep dive through the LLP Act of 2008, showing how it successfully balances risk and freedom.
The takeaway is clear. The LLP is the responsible legal entity, and its limited liability shield protects the partner's personal assets. But that protection is conditional. It demands corporate-level compliance and unwavering integrity enforced by the designated partners and the threat of unlimited personal liability in cases of fraud.
And this framework has evolved, notably with the introduction of the small LLP category, signaling a legislative interest in refining the compliance burden based on scale. That's a key development because it opens the door to future policy debates.
Which brings us to our final provocative thought for you, the listener. If the government continues to relax compliance rules for small LLPs, perhaps by waiving the audit requirement or simplifying annual filings even further, how far can that relaxation go before creditors and the public start to question the true financial health and solvency that the LLP structure is supposed to guarantee?
So where is the tipping point where regulatory ease starts to compromise commercial credibility?
It's a crucial question, especially as the definition of small continues to expand in the dynamic Indian economy.
A fantastic point on the future of regulatory oversight. Thanks for joining us on the Deep Dive. We hope you feel thoroughly informed of the Limited Liability Partnership Act 2008. We'll see you next time.